It is day 2 of the OPEC seminar here in Vienna, a really important meeting of not just OPEC and energy ministers, but also IOCs and NOCs descending on the ground here to have a conversation about the outlook for oil prices in the second half of the year and critical issues shaping this market, not just from the macro, but also to the geopolitics as well. Let's continue the conversation on the ground. I'm very pleased to say that Amrita Sen joins us live now from Energy Aspects. Amrita, great to see you. Good morning from Vienna.
Thank you. Good morning. Lovely weather today for a change.
It's getting warmer, which I'm happy about. But tell me, speaking of getting warmer, what is the conversation inside the room right now, and what are your key takeaways from day 1 of the OPEC seminar?
It's been a bit crazy, I would say, in terms of, just like you said, ministers, CEOs, and I think everyone is worried about what is coming for the oil market in terms of the kind of oversupplied balances from Q4 onwards. But I do think there's also a realization that people came into this year bearish, right? And one of the things we've been kind of talking about is actually inventories are very low. So to get bearish based on forward balances, yes, those forward balances are bearish, but it's too soon. And I think one of the things we've talked about to several people is the current tightness, not just in crude, but I think the thing the market's missing, and I think a lot of people appreciate it in the conversations, is just how low product stocks are. So if generally inventories are low everywhere, there's only that much crude's going to go down, even when you're looking at an oversupplied market. So I think that might only be a 2026 story.
I also think it's interesting, OPEC seems vindicated in the strategy. The UAE Energy Minister Sahel Al-Mazroui saying yesterday that this market is absorbing OPEC's barrels in a nice way.
Absolutely, and I think some of the pieces we've been putting out recently is talking exactly about that. I almost thought that he used one of the lines that we'd written, which is pricing centers are not building. Yes, we have built in Q2, but all of that build has been in China. Outside of China, globally, in the first half of the year, the builds have been half of the 2010-2019 average, and that time we didn't even build very much. So, I mean, if you look at Cushing, we are at the lowest since 2014. US Gulf Coast stocks, we've only got 17 days of forward cover. So pricing centers will need to build first. I mean, otherwise, we're trading $70 Brent with all the tariff noises, with all these expectations of these builds, and I think that's the big difference right now. It's the expectation versus the reality on the ground.
Talk to me about what this all means for Q4 as well. The big debate in the market right now is whether or not we do need to see that additional supply. What is OPEC's next move?
We do think the unwinding continues for one more month and then they are done. That's our expectation. Of course, the decision hasn't been taken. It will be taken on the 3rd of August. That does mean Q4 we build a fair amount, like close to 2 million barrels per day. But again, because inventories are low, we can allow for some builds before we actually see the downward pressure on prices. And when you do see that downward pressure next year, I think one of the other kind of, the hedge fund industry that's also here, they continuously say, oh, but OPEC members are going to struggle. Some will, but the GCC I really don't think will necessarily. I think it will also be a true test for the market to see how much spare capacity there is. There's a headline number of 2.5, but in reality, we've seen Russian numbers. They can't bring back production in terms of what they're meant to. So I think there are some key tests, and at those prices, US shale is really going to struggle. We are expecting some big declines. If it's in the 50s, anywhere between 1 to 1.5 million barrels per day. And I think that's how you rebalance. I think we have to realize that Saudi Arabia and OPEC Plus, they're also playing the long game over here. So I think you have to look at the 27, 28 balances. And I think that's when things start to tighten up, even if, the next, say, 12 months or 2026 is weaker on a relative basis.
Talk to me about the geopolitics as well. We've just seen fresh attacks on the Red Sea. It seems like Yemen's Houthis have been targeting commercial ships again. What signal is that sending about the instability around the geopolitical situation, and how closely are you watching this?
Well, it isn't over, right? Just generally, the market was very quick to price out any geopolitical risk premium. And we've seen, again, with the Red Sea attacks and even sanctions now being talked about on some countries, none of these kind of disruptions have gone away. Freight, like shipping costs, have gone up, and I think rightly so, given what's going on in the Red Sea. And I think it just tells you that any sense of complacency, and we've seen this in this market this year, traders have tried to go short multiple times, and they've been stopped out. I think initially they were long and stopped out, and since then, a couple of times our quant team continue to highlight that, especially deferred, they keep going short and then they get stopped out. So I think a sense of complacency when inventories are low can be really risky.
Is there any geopolitical risk premium in this market right now?
Maybe a little bit at $70, but again, in reality, we had gone up a lot more during Iran-Israel, and we gave it all back. I do think the current tightness is more fundamentally driven.
Talk to me about the Saudi energy minister's comments on the ground here yesterday as well. Stopping short of talking about the recent conflicts, but actually doubling down on the energy transition. What do you think that says about OPEC signaling moving forward?
Well, I think, Prince Abdulaziz has been one of the first to kind of highlight the La La Land conversations around we need a more pragmatic approach to transition, and that's what he's been talking about. He's been mentioning critical minerals for a very long time as well. And I think we've had, certain agencies kind of talk about not needing to invest. And of course, there are some U-turns happening. But generally, I personally think whatever Prince has been saying has been vindicated, because now I do sense there's a far more pragmatic approach to energy transition than there has been in the past couple of years. We do realize, I think, everywhere that the cost of that abating that very last sector to get to that net zero is so costly. And I think that's where the debate has shifted, saying, okay, what's a more realistic path? And that's really going to be along the conversation of my panel today as well, later.
So you'll be speaking at the seminar later on today as well. Let's wrap it up with one final conversation on the pricing outlook as well. I mentioned that there's a lot of debate in the market right now about where prices move towards the end of the year. What would you say is the comfortable equilibrium, and is 70 USD sustainable in the short to midterm, or are prices going to move lower from here?
We think prices move lower, but I really think that's a 26 story. So the Q4 25, if inventories stay this low, sure, we will get a correction, but maybe into the 60s, right? Or even low 60s, but not necessarily into the 50s. I think that's probably more of a next year story. But again, let's see what the winter looks like. If it's a cold winter, demand's going to be stronger. There's so many unknowns. And right now, I think, a month-to-month basis or a quarter-to-quarter basis is probably the best we should be looking at, rather than trying to predict like years out. Structurally, yes, we know where this is headed, but I think there's just too many moving parts. But I really think the big kind of bearish story that people are talking about is a 26 story, not a Q4 25 story.